Okay, so good evening, everyone. Welcome to your cash and financial management revision session. This evening, we're going to be going over task 5, and task 5 covers your liquidity management and cash management. It's worth 15 marks, so you should be aiming to complete it in around 18 minutes. You are likely to see things such as ratios, including backwards ratio analysis, everyone's favourite thing. Gearing, especially, that's very highly examinable in this unit. Overtrading and overcapitalization, and questions on things such as your interest rates, your quantitative easing, money laundering, and terrorist financing. So we're going to get started straight away. Task 5, A, multiple choice. Who doesn't love multiple choice for a level 4 task? I love them. So our first question is, what is overcapitalization? And if we just think about this for a second, overcapitalization occurs when a company has too much cash tied up in its current assets. So that could be anything involved in its working capital. It might be high levels of inventory, excessive outstanding receivables, so lots of money owed into the business from your customers, or it could simply be a lot of cash sitting in the bank account and doing nothing. So if it's just sat in a current account, not making you much interest, it's not doing anything for you. In this case, the business is missing out on investment opportunities because it could be investing that cash in other places and making a better return. So what is overcapitalization? Is it where a business has high levels of non-current assets, where the share capital of a business is too high, where a business has more working capital than it needs, or where a business has idle labour time each week? What do we think? In the chat box. Probably should have just labelled these as well, just to make your life a bit quicker. So if we say A, B, C, and D, what do we think? Okay, so we think maybe it's A, high levels of non-current assets. Well, this is going to depend really on the business. So some businesses are going to have lots of high levels of non-current assets. They might have, think about EasyJet, for instance. They own lots of planes. Planes are non-current assets. They have lots of them. So it wouldn't be this. It wouldn't be the high levels of non-current assets. Let's think about your working capital cycle. So hopefully you're familiar with your working capital cycle. It's going to be your inventory days plus your receivables days minus your payables days. That's what's included in your working capital. So your overcapitalization is going to be where a business has more working capital than it needs. So working capital is, silly pen, is inventory, trade receivables, and trade payables. That's what our working capital is. So overcapitalization is too much of any of these things, or high levels of any of these things. So your answer is C. So our next task is, what is overtrading? Well, overtrading, this occurs when the sales volume, be really clear on this, it's when the sales volume of a business grows really quickly and the business doesn't have adequate working capital to support this growth. So if a business has no long-term funding or a lack of long-term funding in place to finance this growth, they're in big trouble. What's happening is the business is trying to do too much too quickly. If we think about it, if a business expands quickly, then their sales volume is growing really quickly, and to be able to sell things, they're going to need to purchase their inventory, their raw materials, all of those bits and pieces. So they are making lots and lots of purchases, and they're going to have to pay their suppliers nice and quickly so that they can get more deliveries of more inventory and more raw material. So they're paying their suppliers quickly, but all of their customers might still be on 30 days credit or 60 days credit. So what this means is they're paying money out quicker than they're getting money in. And if they don't have some long-term finance backup money in the bank to cover these extra purchases whilst they're waiting for their money from their customers to come in, then they can go bankrupt. And what we say here is that they're basically a victim of their own success. So a business needs to grow at a manageable pace, even though you might like to think, well, the quicker they grow, the better. They have to be able to support themselves. So with overtrading, there's some key indicators to look out for. So as we said, rapid growth in sales or sales volume and turnover. Falling profit margins. So this could be because they've really dropped their prices. They've dropped their sales prices to make lots and lots of sales. Increase in trade receivables days. So if they're paying their suppliers much later, that could be an issue. If their customers are paying them later, that could be an issue. And same in the opposite way. If they've got an increase in trade payables, so that's them paying their suppliers, that could be a sign of overtrading. Also, an increased use of the bank overdraft. Now, each one of these things on their own isn't necessarily a sign of overtrading. It's when you start to see them all together. So if you see a task, this is the kind of thing that will come up in a written task. And if you see a task and they're saying, you know, sales volume has increased by 70% in the last 12 months, but the business is using their overdraft all the time, that could be a big sign of overtrading, because although the sales volume has increased, they clearly don't have the money to fund this. So what is overtrading? Is it where a business has inadequate levels of non-current assets, where a business is open for too many hours each week, where a business has less working capital than it needs, or where a business is charging too much for products? And we'll label these again. So A, B, C, and D. And just think about this one up here. So overcapitalization is where a business had more working capital than it needs. So what do we think overtrading is? Absolutely, it's C. So they haven't got enough working capital. They have less working capital. So these are key words to be really comfortable with. Overcapitalization. And if you think about it, working capital, overcapitalization. It's too much. We have too much working capital. That's where the word overcapitalization comes from. Overtrading is the sales volume is too high in terms of how much working capital the business has got. So the business has got less working capital than it needs. Well done. So the next task is 2 typical symptoms of under-capitalization. Now, be careful with this term here because it throws students all the time. Under-capitalization is exactly the same as overtrading. Same thing, different term. So what do we think? 2 typical symptoms of under-capitalization are high levels of cash, rapid growth in sales, high levels of trade payables and bank overdraft, or high levels of share capital and long-term loans. If you think about these one at a time, high levels of cash. Well, cash is part of our working capitalization. So it's a part of our working capital, saying these words over and over. So actually having high levels of cash is not going to be under-capitalization. Rapid growth in sales. Well, this is what we just said is a term, is a sign of overtrading, isn't it? When a business is selling too much, they're a victim of their own success. They've had this rapid growth in sales and they just cannot cope with it. So this would definitely be a sign of undercapitalization. High levels of trade payables and bank overdraft. Yeah. So here we owe lots of money to our suppliers and we're in the overdraft. So we owe money to the bank as well. So if we've got high sales, but we can't pay our suppliers and we can't pay back our overdraft, there's something seriously wrong. So this would also be a sign of under-capitalization or overtrading. And just to look at the last one, so high levels of share capital and long-term loans. Well, our share capital is our equity. That's nothing to do with our working capital cycle, and neither are our long-term loans. Our working capital cycle is our daily, day-to-day business, normal business things. You know, inventory constantly coming in and out of the business, trade receivables, constantly we're making sales, we're increasing and decreasing our trade receivables all the time. And same with trade payables. A business is making purchases all the time for raw materials, inventory, machinery, all of those different kinds of things. So our working capital cycle, it's the things that change daily or weekly within a business, and long-term loans are not part of that. So if we know there's some overtrading, what are some possible actions to correct the problem? 2 possible actions to correct the problems of overtrading. So we have ask the bank for an increased overdraft facility, take out a long-term loan, reduce the level of sales being made, or recruit more staff. So if we just get rid of the obvious, recruiting more staff is going to make no difference to our working capital cycle. It's not going to help us none. So we know it's not going to be recruit more staff. And I think the power of getting rid of the answers that you know it's not in the first instance is a great tactic to use in an exam, right? So 2 possible actions. If we ask the bank for an increased overdraft facility, the problem here is we already have lots of short-term finance going on. If a business is overtrading, they're probably already in their overdraft. They probably already owe their suppliers money. Taking out more short-term finance is not going to increase that working capital. Whereas taking out a long-term loan, which will probably have lower interest rates, and they can pay it back in small, even chunks every single month, rather than an overdraft, which can be called back for at any time. This is going to be a much more secure way to keep the business going whilst all of these new sales come in, and whilst they learn how to cope and get, you know, some economies of scale and all of those things, maybe some extended credit periods with their suppliers, all of the things that they're going to need to do to increase that working capital cycle. So taking out a long-term loan. And then reduce the level of sales being made. Now, it sounds counterproductive. It really does sound counterproductive. Why would a business want to reduce the level of sales being made? Well, if they can't make the purchases to purchase the inventory that they need to make their goods, whatever it may be, to make, you know, their raw materials, if they can't make those purchases, they're going to be in trouble anyway. So maybe they just need to scale back what they're actually able to sell, reduce those levels of sales. Maybe say if they've got some customers, I don't know, maybe they make drawing pins, something small. Maybe they make drawing pins and they have customers where sometimes they want 50,000, sometimes they want 70,000. Maybe they just need to go to those customers and say, right now, our maximum sales are going to be 30,000 for the next 3 months. It's not great. It's not going to be a great business decision to have to make, but it's better than going bankrupt. Okay, so here's one where we have to do a little bit of calculations. I think most people generally prefer something where they can get the calculator out. So let's have a read through. If the cash operating cycle of a business has been identified as 80 days, when the trade receivables days are 35 days and trade payables days are 55 days, what is the average number of days that inventory is held before it's sold? And remember to round your answer to the nearest day. I always think that a question like this looks a lot worse than it is. You've just got to know how to approach it. So what we need to do is fill in the numbers that we know And then from there, we should be able to calculate everything else. So we know that our cash operating cycle is inventory days plus receivables days minus payables. I'm running out of space. Okay, so what are we told? We're told that where are we? We are told that we have 35 days for trade receivables. So let's pop a 35 in here. And we're told that our trade payables are 55 days. So we can pop a 55 in here. Okay, and that's a minus. So what we've got is 80 days, this is what we're told. So 80 days plus, equals, my pen is not playing ball with me. 80 days equals inventory days plus 35 minus 55. So we've got 80 equals inventory plus 35 minus 55. This is just filling in what we already know. So then we can change that around, and I'm just going to do it over here. So hopefully we can get it a bit nicer. So we can change that around now. We can flip this formula and we can say, let's get a piece of paper instead for clearness. So now we can say inventory days equals our 80 days minus 35 days plus 55 days. So 80 minus 35 plus 55 gives us 100. So our inventory days are 100. Yeah, I was just about to say in chat, do you see where I've got that 100 from? Does that make sense? We've just used what we know. So we know working capital cycle is inventory days plus receivables days minus payables days. So you write that down, plug in the numbers that you've got, and once you've got that bit plugged in, everything else, it's just maths then. I know it sounds easier than it is, but I'm glad perfectly was the exact response I was looking for. Absolutely, you need to be comfortable with the formula. And then it's just a case of putting the numbers in. Let's have a go at the next one then. So a company has the following information for the year ended 31st of the 12th X5. Cost of sales is £960,000. This includes a figure for credit purchases of £890,000. Trade payables as at the 30th of the 12th X5 is £130,000. And we're asked, what is the trade payables payment period? And again, round your answer to the nearest day. So what we need to be careful of here, this is the kind of thing that trips students up in this exam, is we sometimes, especially like during financial statements, things like that, we would use cost of sales to work out trade payables days because that's generally all we're given. However, if we are given credit purchases, we need to use that figure. So here we are given a credit purchases figure of £890,000. So that is the figure we use, not the 960. And that's something that trips students up all the time. So our trade payables days are going to be our 130,000 at the year end divided by the 890,000 credit purchases. Okay. Just purchases always supersede cost of sales. If you are given the credit purchases figure, that will always supersede cost of sales. Yes, because cost of sales also includes the cash purchases. during like your financial statements unit, generally they wouldn't ever split it out for you. They wouldn't tell you what was credit and what was cash, but in this unit they might do. So we've got our 130,000 year-end figure divided by our credit purchases figure. And because we're calculating days, we're going to times it by 365 days. And that should give us 53 days for trade payables. Yeah, well done. It's very much, when you know how, it's not that bad, but it's making sure you're picking the correct figures here. So just take your time to read the question, because it's so easy. I see students do it all the time, just picking up that wrong figure. Okay, and G. So if a company reduces trade receivables days by 5 days and pays credit suppliers 10 days faster, what impact will this have on the working capital cycle? Now, I like this one. I like teaching this one because I feel like this is something that I see students get wrong all the time. And I don't like seeing students get things wrong, but this is how I would do this task. I would use some numbers. Now, you can use any numbers you like. It literally doesn't matter, but let's put some numbers into the formula and we can figure it out. So we know our working capital cycle and we've been given the information. So let's go back to the question a second. All we're told is that they're reducing their trade receivables days by 5 days and paying their credit suppliers 10 days faster. So that means they are reducing their payables days. So they're reducing their payables days, but they're not actually giving us any figures, are they? All they want to know is it going to be increasing or decreasing our working capital cycle? So what I would say is, if you're not 100% confident in how to do this, is to plug some numbers in. So we just make some numbers up. So let's say our inventory days are 20. And we add, I'll just do a shorthand, receivables days, and let's say our receivables days are 25. And our payables days, which we would minus, is 15. This is going to give us a working capital cycle right now of 30 days. 20 plus 25 minus 15. We've got a working capital cycle of 30 days. So we're told that trade receivables reduced by 5 days. So let's go back over here and do this again. Our inventory stays the same at 20 days. Our receivables days have been reduced by 5 days. So our receivables days are now 20 instead of 25. And our payables days, sorry, scrolling up. And our payables days, we were told they were going to be reduced by 10 days. So our payables days have now become 5 days. Because they was 15, we've reduced them by 10, they're now 5. Our working capital cycle is now 35. Okay? So our working capital cycle has gone from 30 days to 35 days. It's increased by 5 days. So this is going to be our answer. Now, you could use any numbers you like. You could put any numbers into this. It would still work out as an increase of 5 days. It doesn't matter. So if you're not sure, just jot it down like this and do your totals. It's nice and simple. And I recommend you use easy numbers like 10s, 20s, 30s. That's what I do. It just makes it a little bit more straightforward. We're getting there now. So fill in the missing words from the options below. The 3 stages of money laundering are, what do we think? We've got placement, something, and integration. In the chat, do you have any idea what that missing word is? We do have a pick list here. We've got due diligence, layering, interaction, bribery, corruption, terrorism, 5 years, 10 years, 14 years. So that's going to be your pick list. And the sentence is, the 3 stages of money laundering are placement, blank, and integration. What do we think that missing word is? Absolutely, it is layering. Well done. The maximum prison term for tipping off is, what do we think? It's going to be one of these. For tipping off, is it 5 years, 10 years, or 14 years? Unfortunately, you will just need to know these for your exam. So how many years do we think the maximum prison term is for tipping off? Pressure, yeah. The answer is 5 years. Well done. Well done. And now we have blank is an offence involving offering or receiving money, hospitality, etc., in return for something you would not normally be entitled to. Yes, well done. Bribery. Well done. So somebody is offering to give you something in return for you doing something else. So in terms of accountancy, it could be your boss offers you a massive pay rise if you adjust the profit and loss to make the numbers look better for them. Okay, a little bit of gearing. I love gearing. It's probably not like, it's not a shared feeling, I don't think, but it makes sense. So the following extracts have been taken from a company's statement of financial position. So we've been given non-current assets, inventory, receivables, equity, non-current liabilities, which is a bank loan, payable, tax payable, and bank overdraft. We've been given all of these things, and we are asked to calculate gearing to the nearest whole percentage. So this is a case of we've just got to pick the right figures off of this statement. Our gearing calculation in cash and treasury is always going to be total debt divided by total debt plus total equity. Okay, so our total debt, what do we think our total debt is? What would you pull off there for total debt? No pressure. Should I give you a clue? Yeah? Okay. That's okay. That's absolutely fine. So our total debt is going to be our bank loan. That's a debt of the business, and that's 1,200. And also our bank overdraft. So it's all our money we owe to the bank. There could be other debt on there, but those are 2 really common ones. It's debt. It's how much do we owe? So on our total debt side of the formula, we've got 1,200 plus 190. And we're dividing that by our total debt plus total equity. So we're dividing it again by 1,200. Let's put my brackets in. 1,200 plus 190 plus, now we need our total equity figure. So our total equity figure is literally given to us as equity, and it's this. Yes, absolutely, 3,300. So it's 1,200 plus 1,900 plus 3,300. And that's our formula. And if you put that into your calculator, you should get a nice whole 30%. Now we're going to change things up a little bit. So We're using the same extract from the statement of financial position, but we're told the business is considering financing the purchase of a new machine at a cost of £900,000 by increasing the bank loan. Now, remember, our bank loan was part of our total debt. And we're asked to calculate the revised gearing ratio if this takes place. And we're entering to the nearest whole number. So if we're doing the revised gearing ratio, if they increase the bank loan by £900,000, all we need to do here is add this £900,000 on to our total debt on either side. So this now becomes 1,200 plus 190 plus 900. So we're just adding that extra debt on because they've increased their bank loan by 900. So 1,200 plus 190 plus the new 900 divided by 1,200 plus 190 plus 900, which is our new figure, plus that 3,300 equity. So all we've done is added that £900,000 into the total debt on both sides of our formula. And when we add that in, pump it all into your calculator, you should get 41%. And that is the whole of task 5. And it's very much a case of knowing your formulas, apart from this one. These things here, such as your years, you will need to know those. It's write them down on post-it notes, write them down on your hand, listen to yourself, listening to them back on a voice note, whatever works for you. Unfortunately, you do just need to know them. And on things such as a task like this, you will know how to do this. If you've done your financial statements unit, you will know how to do this, but it's taken a minute to look at it and go, right, total debt. Our non-current assets total debt. Well, no, they're not. We own them. Then they're not debt. Inventory, is that debt? Again, no, we own it. It's not debt. And just do the power of deduction. Just go through and think, just be really kind of simplistic with it and go, well, is this a debt? And our debts are going to be things such as our bank loans and our bank overdrafts. And if you go through it nice and slowly, you should be able to kind of pick out the right numbers. Okay, I hope that's helped. I'm going to end the recording now. We will do task 6 in the next session because tonight we had some technical issues and it's rather late now. So we will be back on Wednesday. You're very welcome. I hope to see you there. Let me stop this recording.